Welcome to Short View Trading. It's Monday 28th of November around 9 a.m. London time. So what matters for markets on a 1 to 2 week basis? What matters if you're a swing trader of those equity indices? You want to trade the S&P 500 futures index on a long or short basis. What factors should you be looking at to think about implementing that trade and running that trade over the next week or two? That's what we want to talk about in this video, how to trade, how to swing trade equity index futures. So it was a shortened week because of Thanksgiving, but the S&P still managed to hold on to its gains and put in a little bit more gains over the course of last week. As you can see on the chart in front of you now, this is weekly performance of key US equity indices. The S&P was up 1.5%, other indices were up a similar sort of amount. So it was a positive move, and with that we had the S&P 500 move back towards the top of the recent trading range. Really, since that very strong surge on the back of the CPI data in the middle of the month, the S&P 500's existed mostly in a 100-point range from 3950 to 4,050, as you can see in this 10-day tick chart that we're putting up in front of you now. And of course, the longer we stay at these elevated levels, the longer we stay and hold on to the gains of the past couple of months, the double-digit S&P 500 gains, the longer that continues, the more the bulls become emboldened. And indeed, in the last couple of weeks, they've been emboldened by the call from Goldman Sachs for a soft landing in the US economy. This call by Goldman Sachs, as you can see, as we're scrolling the piece across the screen in front of you, that's about their view on the Phillips curve and indeed the Beveridge curve. In other words, their view on the labour market, that the Fed can deliver a soft landing because they can have a slight uptick in unemployment, nothing too dramatic, that brings inflation and wage growth down and allows the Fed to achieve that wonderful, perfect soft landing. But in reality, this inflation isn't about the labour market. It's been the best example of monetary inflation in the last few decades. And of course, it's the monetary metrics that you need to look at to work out what's going to happen to an inflation. And if you look at monetary metrics, you look at money supply now in the States, it's contracting. Added to that, so many indicators are forecasting recession in the US, it's hard to believe a soft landing is plausible. But the bulls have latched onto this. It's convenient, it works, it fits their narrative. We've had peak Fed hawkishness, peak inflation, and now we're going to get a soft landing, and therefore we've had the lows in this equity market. That's the bull case argument. If you're interested in the bear argument, the three reasons why we think this bear market continues, please do sign up for our investor subscription on the website, and you'll get a copy of the bearish argument that we think is going to drive this market over the course of the first half of 2023. Either way though, the S&P 500 is now back pretty much at its 200-day moving average, that level it got to in mid-August, its key trend line, its key resistance line, and there's little out there that's obvious that's going to get this market excited from here. We had a bit of a fall in inflation, that's priced in. We had some initial excitement about zero COVID ending in China, and that of course has gone away. And now we're contending with the idea that protests are building in China, and there's the risk of a second Tiananmen Square style event, causing markets much concern over in Asia. So where does all that leave us? Where does that leave us in terms of a 1 to 2 week trade, a swing trade on the equity index futures? Well, if you look at some of the models, it's concerning, or it's encouraging if you want to put in a short position. The VIX has come back to its sort of 20-odd level, the lows of the range of this year. The VVIX is ticking up, and the steepness of the VIX volatility curve is back on sell. All of that, coupled with our market vulnerability model, which we're showing you now and has just generated a signal, leads us to be concerned about this equity market and suspect that the short side is the way to play it from here, particularly if you're a 1 to 2 week swing trader. So to see the full range of models and our view on this market and our regular update on our recommendation, our trading recommendation, that 1 to 2 week view on S&P 500 futures, please do subscribe to the Daily Rag or take a free trial. Just click on the link below, give us your name and email address, no credit card details required, and we'll send you the Daily Rag for free for a bunch of trading sessions. So what are we watching today and this week? Well, there's a ton of stuff going on, a lot of key events and key macro data releases. Got a couple of big central bank speeches this week. Jerome Powell on Wednesday on the economic outlook, labour markets and inflation. And then Christine Lagarde at the back end of the week as well, laying out some monetary policy views. Those are both critical speeches. In terms of macro data, it's a big week in the States with the ISM manufacturing on Thursday and then non-farm payrolls and average hourly earnings on Friday. A ton of other US stuff over the course of the week. And then over in the Eurozone, we've got some inflation data, headline and core flash Eurozone inflation. We've also got PCE deflator out the States. So plenty of more updates on the whole Western inflation debate as well. So that's it from us. That's your morning market hit for Monday, 28th of November. Thank you for listening. Please do subscribe on YouTube. Simply click on the subscribe button or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe. Trade well.